Many cannabis operators make the same real estate mistake. They buy the property in their personal name because that's how the loan was approved, or because they already own the building, or because their attorney recommended it for liability purposes. Then tax season comes around, and they assume they can treat the property as part of the business because the title isn't in the company's name. That assumption can cost them tens or even hundreds of thousands of dollars. I'm Daniel Sabet, CFO at GreenGrowth CPAs, and I've worked with cannabis operators across multiple states on tax planning, entity structuring, and real estate strategy. One principle comes up over and over again in tax law. The IRS looks at substance over form. In other words, the IRS generally analyzes what is actually happening economically, not just whose name appears on a piece of paper. The specific tax treatment depends on the facts and circumstances, but economic reality often matters as much as legal title. Understanding that concept can dramatically change how cannabis operators think about their real estate. Now, here's a common example that we see. Let's say a dispensary owner purchases a building for $2 million. The mortgage is the owner's personal name because the bank would not lend directly to the cannabis business. The deed is also in the owner's name. Many people immediately conclude the business doesn't own the building, so the business can't benefit from it. That necessarily isn't true. The important question is how the property is actually being used and how the transactions are structured and documented. If the property exists solely to operate the cannabis business, the business pays the expenses, the business occupies the facility, and the arrangement is properly documented, the tax analysis focuses on the economic substance of the arrangement, not simply whose name is on the title. This principle throughout tax law. The IRS routinely examines the actual business purpose, as well as the flow of money, contractual arrangements, and the economic realities when determining tax treatment. Simply changing the name on the deed does not automatically determine the tax result. Likewise, merely using a property for business does not automatically entitle a taxpayer to every business deduction. The overall facts, documentation, and applicable tax rules still matter. That is why proper planning is essential in the cannabis business. I see the situation frequently in cannabis. An operator starts a cultivation facility. Their LLC cannot obtain financing because cannabis remains federally illegal. Instead, the owner personally purchases the property. The business then spends hundreds of thousands of dollars building out the facility, installing security systems, HVAC equipment, lighting, irrigation, and specialized infrastructure. Several years later, someone says, the property is personally owned, so none of this belongs to the business. That oversimplifies the issue. The IRS has long applied the concept that substance controls over mere form in many tax contexts. Courts and the IRS often look beyond labels to determine the true nature of a transaction. The question becomes, who is actually using the property? Who bears the economic risk? Who pays the expenses? Who receives the economic benefit? And what agreements exist between the owner and the operating business? How is everything reflected in the books and records? The answer to those questions are often more important than simply looking at the deed. For example, suppose the owner leases the building to their cannabis company under a properly documented lease. The business pays rent. The business operates exclusively from that location. The owner reports rental activity appropriately. Now there is an identifiable economic relationship supported by documentation. Contrast that with an operator who simply pays personal mortgage payments from the business checking account without documentation, without a lease, and without proper accounting. Those situations create confusion and increase audit risk. Good documentation turns a fact pattern into a defensible tax position. Poor documentation creates uncertainty. So what should cannabis operators do? First, understand that entity structure and tax treatment are not always the same thing. A property may be legally titled one way, while the tax analysis depends on the actual economic arrangement and the tax rules. Second, document everything. If the business uses personally owned building, work with your CPA and attorney to determine whether a written lease or other formal arrangement is appropriate. Maintain records showing who pays expenses, who occupies the property, and how transactions are accounted for. Third, keep clean books. Separate personal expenses from business expenses. Record rent, improvements, maintenance, and capital expenditures consistently and accurately. Finally, plan before you file. Real estate is often one of the largest assets in cannabis business, and mistakes can be extremely expensive. The goal is not to create aggressive tax positions. The goal is to accurately reflect the economic reality of the business while complying with the tax law. The IRS has long recognized that substance over form is an important principle in tax analysis, but every situation depends on its specific facts and documentation. The operators who build strong structures, maintain proper records, and seek professional guidance are the ones who put themselves in the best position for both compliance and long-term success. Thank you for watching. Stay sharp.